Hello viewers. Today in this video we will learn about how does pledging of shares by promoters impact stock valuation. First, we shall ask ourselves the question, what does pledging of promoters' shares mean? When an individual is trying to analyze a stock by going through the company's fundamentals, there are various aspects that need to be considered. Apart from analyzing the financial ratios and management efficiency, looking at the pledge amount on promoters' shares is crucial in identifying signs of financial trouble in the company. A promoter is an entity, an individual or a firm, responsible for the incorporation of the company. During its initial stages, the majority shares of the company are held by the promoters of the company. In India, promoters are also the group of majority shareholders that manage the daily affairs of the company. When a company needs funds for regular operations or expansion, it has several options to choose from, like raising equity capital, issuing corporate bonds, approaching a bank for a loan, etc. To avail of the loan, the company needs to provide some collateral to the lenders. Usually, financial institutions and banks ask companies to offer promoters' shares as collateral for the loan. This is pledging of promoters' shares. Next, we shall see whether pledging of promoters' shares is bad. Short answer is no. If a company has a high promoter holding, then pledging promoters' shares is a common practice. An individual takes a home loan to buy a house or a car loan to buy a car. There is nothing bad about it, but it is an indication that you do not have funds to purchase them upright, and are willing to pay interest to avail of a loan for the purchase. Similarly, if a company has pledged the promoter's shares, then it is an indication that it might be in troubled waters. Now, let's understand how does pledging work. Banks or financial institution offer a loan to the company with promoters' shares as collateral. This means that banks can sell these shares if there is a default made by the company and recover its dues. Let's understand this mechanism with the help of an example. Suppose, Company A wants a bank loan for its expansion plans and is willing to pledge promoters' shares for the same. The market price of the share is 100 rupees. The company needs a loan of 50 lakh rupees. The bank usually offers a loan of up to 50% of the market price of the share. So, if the company pledges one share, the bank will offer a loan of 50 rupees. Since the company needs 50 lakh rupees, it will have to pledge 1 lakh promoters' shares with the bank. The difference between the loan amount and the market price is kept by the bank as security. If the market price falls, then the bank asks the company to deposit more security or pay cash and reduce the loan liability to maintain the margin. If the company fails to do so, then the bank reserves the right to sell the shares in the market to maintain the margin. How does it affect stock valuation? Higher volatility in stock prices. Higher the percentage of promoters pledging, higher could be the risk of volatility in the company's share price, because when the share prices fall, the overall value of the pledged collateral falls. This would put pressure on the promoter either to repay the loans or to produce more assets as collateral. Possible loss of control of the company. There can be cases where the promoters lose the management control of the company. Let's say that the promoters owned a 60% stake in the company and pledged half of it for a loan. If the company fails to repay and the lender decides to sell the pledged shares in the open market, then the promoters will be left with only a 30% stake in the company, risking losing control over the company. Possible value trap for value investors. Value investors try to look for stocks that are undervalued as compared to their intrinsic value. Many companies with a high percentage of promoters' shares being pledged trade lower, making them attractive to value investors. So, if an investor finds a company with more than 15 to 20% of the promoters' shares being pledged, then he must assess its cash flow before making any investment decisions. Also, if a company has a high amount of pledged promoter shareholding, then stock price erosion is a distinct possibility. That's it for today, and I hope you found the video useful. You can contact us from the details mentioned on the screen via WhatsApp, email and call. Thank you for watching the video to the end. Please do like, share and subscribe our video for the latest updates in the stock market.